Hello everyone, welcome to today's US Open live webinar. This Tuesday, January 9th, 10 minutes before Wall Street opens. As always, I am your host, Nikos Tsabouras, Senior Financial Editorial Writer at FXCM. It's been a slow week, relatively slow week so far, with mostly mixed trends as markets look forward to Thursday US inflation report. And so far, we mostly had some reaction to dovish commentary from from the Fed's Governor Bauman, who is of course a voter, and also digest last week's strong NFPs from the United States and the mixed inflation data from Eurozone. And of course, in all that, we also have heightened tensions and hostilities in the Red Sea, which support oil prices. This is what we will be pretty much be talking about in today's session. But as always, before we begin, please go over the risk warnings and the disclaimers carefully, and then we will start. Once again, before we begin, please read carefully through the risk warnings and the disclaimers. Let's give you a few more seconds to do that, and then we will get started. Okay, let's get the ball rolling. We're going to start as usual with Euro USD, talk about the data, the Fed commentary from the United States, as well as the inflation figures from Eurozone, that is from last week. And then we're going to talk about US oil, and we will round things off with the SPX 500, the broad US index, and also what's ahead, which is mostly the US inflation report on Thursday. So the pair Euro USD shows some indecision amidst recent mixed views from both sides of the Atlantic in the aftermath, of course, of December's monetary policy decisions. The European Central Bank had pointed to peak rates as it has made substantial progress on inflation lately, while the economy is in a bad shape. Despite that, however, the central bank maintained a hawkish bias and ruled out any talk of rate cuts. And last week's preliminary data were mixed because preliminary inflation data, because they showed a reacceleration in headline inflation, but core CPI continued to cool down. So some ambiguity there. Now, on the other side of the Atlantic, the Fed has definitely been less hawkish, than dovish, perhaps we could say, and had embraced lower rates last month, with its updated projections pointing to at least 3 rate cuts this year. Now, yesterday, Governor Bauman played into that theme a little bit because it softened her stance, saying that the policy setting now appears to be sufficiently restrictive to achieve the 2% inflation target. In a dovish term, we would say. However, she did not rule out further hikes, nor had Chair Powell last month done so either. So there is still a possibility for further tightening. Inflation is still elevated and has shown persistence, while Friday's employment report pointed to a strong labor market with the addition of more than 200,000 jobs in the highest print since September. So we have had some inconclusive data, and the policy differential between the ECB and the Fed is a bit murky at this stage. And as you can see on the chart, there is some lack of direction over the past few days in EUR/USD as well. In any case, the ECB is further from cutting rates, at least in terms of rhetoric, and with EUR/USD above the 200-period EMA following a profitable 2023, it has the ability to push back towards the December highs at 1.1140, but we are still a little bit cautious. On the other hand, the current year started on the back foot, and there is risk for renewed pressure towards the 1.0722 handle, although a strong catalyst would be needed for a bridge, and we can also see the Ichimoku cloud right above that level, this blue cloud that can also provide support. And in any case, as we said, the next leg of the move would be probably determined by Thursday CPI inflation report, and we will talk a little bit more about that at the end of the session in the What's Ahead segment. Now let's move over to oil prices. US oil comes from a poor third quarter amidst worries around demand and prospects for strong non-OPEC supply, and this keeps it in a precarious position and exposed to the December lows at 65.69, although sustained weakness towards and below 63.63, that is the 2023 low, has a higher degree of difficulty. And that is because OPEC and its allies has slashed output for the first quarter, extra output cuts for the first quarter of this current year. And last week, they reaffirmed their commitment to this reduction plan. And there is also an escalation in Red Sea hostilities, which interrupts supply and that supports oil prices. As such, there is opportunity for return above the 200-period EMA, the black line that we see on the chart, which could pose the bearish bias, but the upside is generally unfriendly. You can see also this trend line, which comes from the 2023 highs, which is another roadblock, and of course, right above it, a thick falling daily Ichimoku cloud, which can definitely contain any stronger recovery efforts. And with a couple of minutes before Wall Street kicks things off, let's turn to the broader SPX 500 index, which was not really harmed despite the volatility by Friday's solid jobs report, which did dampen expectation around the Fed's rate cut path, but did not really alter market pricing that much. And the index got a boost yesterday from the dovish Fed commentary that we already talked about, or at least not so hawkish. Perhaps dovish is a stretch to label it dovish. It's still on the verge of new record highs, located at 4,820, although the next leg will likely be determined by the upcoming inflation data. On the other hand, the index dropped last week. Markets may be overly optimistic about the extent and timing of Fed cuts, so there is room for disappointment. Just to sum up, the Fed projects 90 basis points of cuts this year, while markets, according to CME's FedWatch tool, price in 150 basis points of cuts starting as early as March. SPX 500 is exposed to the crucial confluence of supports at around 4,650, where we have the 200-period EMA and the 23.6% Fibonacci of the last leg up. and the bridge could send it toward the 38.2% level, but deeper correction has a higher degree of difficulty. In any case, expectation is for new record highs, even if a deeper pullback is required. And having said that, let's round things off with what's ahead. It's mostly the US December CPI inflation on Thursday. The Fed has made substantial progress on cooling price pressures, but inflation remains well above the 2% target, and the recent data have shown persistence. Core CPI had stayed at 4% in November, and headline had ticked down only marginally to 3.1%. So there is a chance that more work is needed, or at least by the Fed, or at least prolonged restrictive stance, as the Fed itself has touted, despite pointing to rate cuts this year. So at this stage, further tightening has not been ruled out, and a key factor in that will be the progression of the inflation data. So that is pretty much it from me. Our next session is on Thursday, 10 minutes before Wall Street opens, as always, and we will talk more about the outcome of the CPI report and more key data, and of course the new earnings season that gets underway. That's it for me for today. Thank you for joining.